Welcome back to Financial News with Kyle. I am your host, Kyle, and you are here for financial news. Today's date is May 21st, 2024. And a quick disclaimer, I am not a licensed financial advisor. Everything I say is of my own opinion, and this is not financial advice. Do your own research. So upcoming here, we have tomorrow the federal meeting minutes release that will be released on May 22nd of 2024. And that will be the minutes of the most previous meeting that they had of last month. So during that meeting, they decided to keep interest rates exactly the same. For the sixth meeting in a row now, rates have remained unchanged. And I largely expect them to continue to remain unchanged for the foreseeable future, at least potentially until possibly September, October. We might see just a small incremental decrease in rates just to kind of test the markets and see how they react to it. But they are very adamant on keeping those rates pinned at 5.25 to 5.5%, trying to get that inflation rate back down to 2%. I do believe that they are going to keep the 2% target. There's lots of rumors going around online that we might see them changing what the target rate that they would like to get to will be. I'm not quite on board with that synopsis. So we'll see what they do there. Economic activity and inflation. Largely the economy, even though there's a lot of people complaining and balking about it, largely the economy is doing relatively well. People are remaining employed. There's plenty of companies still hiring, though you are seeing more and more some of the kind of like scam employment schemes going on. And we'll have to look a little bit more into that. I think that's some interesting stuff. But production is still good. The economy is still rolling. People are still buying houses. People are still buying cars. They're feeling it in their wallet, but not to the point that they really are committed to slowing down their spending. So we'll have to see how economic activity kind of changes again in the coming months. If it starts to really slow down, they said, federal agencies and banks and all these surveys and reports that they were doing said that people were out of money months ago, all the way back in January and February, and we're still not seeing that. So balance sheet reduction. The Federal Reserve is continuing to reduce their balance sheet. They did very well for the past 16 months, in my opinion. They were reducing by about $60 billion a month. Originally, they were only projected to be doing the balance sheet reduction between, I believe it started about mid-2022, and they said it would be going until at least the end of 2023. And if I'm not mistaken, that was about $90 billion a month that they were reducing their balance sheet. So they are still continuing to reduce their balance sheet. The last time I checked, the balance sheet was down somewhere north of 17% from the almost $8 trillion in assets that they were holding almost 2 years ago. So significant progress there. And we continue to see that in the markets too. We see the markets being less and less liquid, in my opinion, especially in the indexes. You're seeing a lot less volume being sent across the platforms from a day-to-day basis compared to where they used to be 2 years ago. So happy to see that the balance sheet is still reducing, and we'll just have to stay posted on that. I hope that they continue to do so. Recession concerns. I just kind of picked a couple topics here to go over. Recession concerns. We're already we've largely already been in a pretty mild recession, I'd say. It could certainly be a lot worse. Could have been maybe if action was taken a little bit sooner, maybe not as bad. But it is what it is. Some economists would say that we're not in a recession. Some say that we've been in a recession for over a year now. I think the general consensus is that we are in a recession, but in my opinion, it's a pretty mild one. It's a pretty soft one. So the hope is there that it just doesn't get worse. Obviously, we don't want an escalating recessionary state in our economy. People begin to panic, and inflation will still be going on, and everything's already kind of roughed up. It would just be putting it all through the boxing ring one more time, and that would not fare well again. Debt ceiling crisis. I mean, come on, how many times have we been here? I mean, the debt ceiling crisis. They're gonna raise it. They're gonna wait until the very last minute, and they're gonna raise it the same way that they always have in the past. So it's kind of like the what is it? The federal budget. They delay it until the very last week. Everybody's going into a panic. All the mainstream media companies just get free content, free clicks, free views, and it's just a big nothing burger. It's just a big nothing burger. So when it comes to the debt ceiling, they'll push it up again. They'll just keep raising it. I mean, they have no choice. So that will go higher into the high 30 trillions and maybe even the low 40 trillions. But who cares? It's all just a big number in a spreadsheet at this point. Future outlook. The committee remains cautious, stating that future rate adjustments will depend on incoming economic data and the evolving economic outlook. That's what they've been saying the whole time. I don't expect that to change at all. I think as we see inflation start to slow down, which there has been some signs of that recently, then we can start opening up the discussion of lowering the interest rate on a timeline that is more near than far. So we'll have to see what tomorrow, if they change any of the language from their meeting in the minutes and kind of modify the outlook or the opinion of what the Federal Reserve stance is on our economy currently going forward until the next meeting. Though largely I'm expecting this to be a non-event. So sometimes these events just like to cause volatility in the index markets or the markets as a whole. I'm a big believer in that some of these news events are not a direct correlation and causation for volatility in economic markets, but rather an excuse for volatility in these markets. Big hedge funds and Wall Street traders and prop firms and all that good stuff, they're all looking to continue to position themselves for future news events, and meeting minute events are by and large, I think, just an excuse to rock the boat, get a bunch of retail investors going wild, buying and selling, creating that volume, creating that liquidity that they need to pass millions of shares. I mean, whether they're buying or selling, either way. So we could see a lot of a whipsaw, some up and down and back up and back down, or we may not actually see the true direction, if the direction changes at all, that the impact of these meetings have until 1 to 2 days after the fact. So historically, sometimes you see that too. The markets will rally into the afternoon, and then overnight they kind of stall and go stagnant. And then the next session, Thursday morning or Friday morning, then everything plummets. And sometimes you see the opposite. Sometimes it takes a big dip on good economic data, and nothing's really making sense if you're a fundamental trader. But then in the following days, everything's going to rally again. So it's those big funds just playing games, just trying to rock the boat, get everybody in a panic, get that volume flowing, so that they can more more what's the word I'm looking for? More stealthily. Is that a word? They can more secretly trade those millions of shares that they're wanting to offload or get on their books. So thank you for watching. That's all I have for today. I will post another video in the upcoming days. Post meeting minute releases, and then we'll look forward to more economic data coming out in the near future, and we'll have videos for that. So thank you for watching. Please like and subscribe. Much appreciated, and we'll catch you next time.